All right, we'll give it a shot then.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents or independent contractors are in such capacities licensed financial advisors, registered investment advisors or registered broker-dealers. Nothing contained in this webinar, website or promotional material constitutes a promotion, recommendation, solicitation or offer of any particular investment, security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone.
Okay, I know what it is. She's depressing. It's like this. It's like you've lost that loving feeling by the Human League. That's what I just realized. That's what she reminds me of. So it's like this. Right. Yeah, this is what she reminds me of. See, I love that song, but it's like music to commit suicide, but too, you know? So it really is crazy. It's so depressing. Anyhow, so yeah, you know, okay. Good lesson. So, you know, you hear all this bullshit about artificial intelligence and so on and so forth. And meanwhile, this is what they call state-of-the-art speech recognition technology, that it can read something and talk about it, but it makes tons of mistakes along the way, just like spell checkers still do, just like when you try to talk to Siri or you try to talk into your text machine on your phone and it gives all these errors and says wacky stuff that makes no sense. You know, a lot of technology and things, they sound great, but the reality is miles away. And we know this. It's not surprising. You're not like, oh my God, they said Siri was going to be amazing, and it's not. You know, you don't believe that these things are going to be so incredible. But the problem is, even though you understand this and you know it and you've experienced in your life many, 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 many things that they told you were going to be so amazing and turned out not to be, still, people are running into companies like Tesla and space, Virgin Galactic and SpaceX and things like that, as if everything that they're promising is going to actually happen at some time in the near future. And they're not. And if they're not, then it's not necessarily a good investment. And yet a company like IBM, which is also on the AI front, but a company like IBM that just simply grinds out steady gains year after year after year with steady income and makes progress and has research and development and grinds out minuscule improvements, just like they used to make fun of Steve Jobs, right? With Apple, and they say, oh, what's the big deal? The new iPhone has this, or the new iPhone has that. Or, oh, now you have a camera, big deal. Oh, now you have a better camera. So what? Oh, now you have Siri. So what? Every time something would come out on the iPhone, it was like, oh, that's not such a big deal. Who cares? Go back and invent something really new. It's the people tend to assign a much higher value to companies that don't actually have something than the companies that really have something and are producing consistently good products that sell. It's crazy. The worst thing Virgin Galactic can do, and if you guys aren't following along, it's the company Space SPCE, SPCE, completely insane pricing, up another 10% today. Who knows where it's going to stop? It was $10 a month ago. that was so a month ago, though, And I did the math yesterday. I did some of the math anyway. And all right, well, we'll figure it out. Okay. So yesterday we were talking. Oh, here we go. Good. Hang on. Okay. So here you go. Company obviously no revenue. They hope to have 4 million in revenue in 2019, 7 million in revenue next year, and on that 4, they're only going to lose $175 million. And next year, they're going to cut their loss down to $65 million. That's pretty good. And $30, we're at 35 now, is $2.3 billion. So now they're well over $2.5 billion, probably 2.7. Understand that it's $2.7 billion for 5 million in hopeful revenues. Well, that's over. I mean, 219 are 219 is over for 7 million in revenues. So basically, 300, 3,000 times earnings, 300 times earnings. I can't do this. It's obviously 300. It can't be 3,000. So it's 300 times earnings. So I'm sorry, 300 times revenues. There are no earnings. Earnings are negative. So it's 300 times earnings. Now, on the bright side, they're not burning too much money, but that's a weird kind of bright side, because the bright side is because they aren't doing anything. They have one ship. It's the same ship they've had for 10 years. So it's already old technology, basically. But so do all the airlines, right? That's like every plane is like 20 years old. You get on 40-year-old 747, so that's not the point. This is a space tourism thing, but the planes only hold like 20 people. So you're only going to collect here. How many seats on Virgin Galactic? What a crazy question, huh? Oh my God. How many seats on Virgin Galactic? Spaceship 2, blah, 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 blah. How much is a seat? Okay, it's got to tell us here. Control F, seat. Cost per seat. Seat. Damn it. Nope. Virgin Galactic collaborating with Boom Technology. That's different. All right. Anyway, I'm under the impression there's 20 seats. I'm surprised this is not a statistic you can actually find out. But anyway, see, they maiden flight by the end of 2009. It was delayed. 2014. This is 2020. This is a 10-year-old plane, more than 10 years old. So it took them 10 years and $1 billion to build a plane. That plane has, calculator please. All right. So the plane has 20 seats at $250,000 per seat. That's $5 million. So even if you were able to do 200 launches a day, that would only, I mean, 200 launches a year, that's 1 billion in revenues. And even if, and that's assuming that you filled all 20 seats, it's assuming there are 20 seats. Maybe I'm wrong about the number. There's certainly not a lot of seats. You have to, you know, it's like the space shuttle. You can't have that many people in it. So if you flew 200 flights a year, which I super doubt, okay, because I mean the space shuttles fly once every few months. This plane has flown 9 times in 10 years, and 4 people have died in those 9 flights. 3 on the ground in launch accidents, and one actually in the capsule. So far out of 9 flights, 4 people have died. And it's taken them a flight maybe once a year. They managed to do a launch. To get to $1 billion in revenue at $250,000 per 20-minute ticket. Understand that also. It's a 20-minute flight. You're in space for 20 minutes. That's it. And then you come back down. It's like that thing. It's not really any different than the thing where they take you up in a plane and they put you into free fall. Honestly, your experience is going to be basically the same. So again, it becomes very silly. It's like, what are you doing? So an altitude of 82.7 miles, which is officially space. So you officially get to space, so you can tell people you were in space. Anyway, but regardless of what kind of value you see in spending $250,000 a ticket, if you did 200 flights, that's $1 million. Now the problem is, though, that's 4,000 people who are willing to spend $250,000 to be up in space for 20 minutes. Are there 2,000 people like that in the world? I guess, but are there? But $1 billion in revenues is never going to justify what their market cap. I mean, there's the cost to launch, so on and so forth. They're not making the 250,000 every flight. They have to have a whole team. It's an actual space launch. It's not an airplane, it's a space launch. It takes a huge amount of crew and so on and so forth, preparation and massive amounts of fuel. I'd say environmental protests alone should shut this thing down. It is bullshit that these companies intend to expend huge tankerfuls of gas to take people up to space for 20 minutes. It's just crazy. So even if you could use a capsule 200 times a year, and even if you could crew it and man it and so on and so forth, and even if you could do that without any mistakes and no accidents, no downtime, and so on and so forth, and even if you have 2,000 people every single year who hand you deposits. Oh, I remember what the number was. That's right. He's got 500 or 600 deposits, and they say that's a full year's worth of flights of people. So, that number is way lower than this. So they're saying 600 people times $250,000. $150 million is really the most they expect to be able to take in a year. And that's the thing. People don't read these things. I mean, so if the most they can, the net, the gross revenue, $150 million, where are they going to make enough to justify a $3 billion valuation? If all you're making is $150 million in gross revenues, those are not profits. So obviously people say, well, yeah, but they're going to build another plane and another plane, and then they'll have multiple planes, and then they'll be able to do what? Well, if it was $150 million for one shuttle, then let's say they can do $450 million in revenues on 3 shuttles. Well, that's still not much money. Boeing is way smarter. Boeing put an extra seat on the plane that NASA's paying them to go to the International Space Station. They made a deal with NASA to split the revenue, and they've got 1 tourist seat to NASA for like $1 million something per flight. So one person gets to go to the International Space Station for 10 days. Oh, I'm sorry, 20 million. No, 1 million. 20 million. So with Boeing, they give 10 million to NASA, and they get $10 million every time they are doing an official trip with people who's supposed to go to the International Space Station, they're going to allow one tourist to go along for 20 million bucks. That's a better business model than what Virgin has. All right, it's not going to make it won't make as much. It won't make as much net gross revenue. You know, maybe they'll do 5-10 flights a year. Maybe 200 million, 400 million. Actually, it is as good as Virgin. So let's say if they do 10 trips a year, that's $200 million in gross revenue, and it's mostly profit because they don't have any cost. They're already being paid to put that ship up in space. NASA's already paying them to go to the International Space Station and shuttle people back and forth, and supplies and so on and so forth. So they're just adding a passenger. All they did is beef up the existing craft by whatever percentage it takes to carry one more person's weight and add a seat. But they're not adding crew, they're not adding ground power or anything else. It's just pure profit, that one seat. Virgin has to sell 100 tickets to do that. So in other words, one of their 6 launches a year, one of their 20 launches a year, whatever, or 30 launches a year would have to be not one. I'm sorry, if it's 25, five of their 20 or 30 launches a year would have to be dedicated to that to make that money back. So it's way smarter for Boeing doing what they're doing. So let me see. So this year, blah, blah, blah. Okay. So Virgin has the one ship and they're supposed to have 2 more. 2 more are going to cost God knows how much money. They spent $1 billion on the first one. You got to figure most of that was R&D though, or well, not most. I mean, it's probably an expensive ship, but you know, maybe a couple $100 million for a couple more ships. And, but then where are they going to get all these people? Where are they going to get thousands of people to pay $250,000 a flight? You obviously you can't. You'd have to wait forever. I think Boeing is going to have no problem selling these seats. There's only 10 people on Earth in a year that would be able to make this trip. I mean, 10 non-astronauts, and there are obviously thousands of billionaires who wouldn't blink at spending $20 million for an experience like that. So that I can see. Hundreds and hundreds of people every single year lining up to take a $250,000 flight. Now I've been on the Concorde, and those seats were $3,500 at the time, which was a lot of money back in the day. And there was an endless supply of people for that. People flew. Well, there was, but on the other hand, the Concorde ultimately went broke, didn't it? You could see space. You were so freaking high up in the Concorde that you could see you could see the Earth curving below you. That was the coolest thing ever. But I'm sure this is just as cool as far as an attraction, but that is a big difference between $3,500 and $250,000. Let's say in today's money, the Concorde was probably $10,000. But you were going somewhere. It accomplished a purpose. This doesn't even take you anywhere. I think Virgin Galactic would be smarter if they actually flew you to England, so at least you'd be somewhere when you were done with your flight. So anyway, so the promise of things. In other words, because they have no revenue, because they have no income, it's easy to extrapolate and fantasize about all this amazing stuff. Oh yeah, notice that in 2017 they had 650 reservations. Right now they're saying they have 600. So they aren't exactly like overbooking. It's not like flowing over with people who are signing up for this for advanced purchases. But anyway, so you have this problem of people who, way overpromise, but it obviously takes so long. It's going to take years to find out that this doesn't really work. It'll take, even the Concorde, everybody, if you were on the Concorde, you would think they were doing great. The thing's packed, and you're sitting there, wow, $3,500 times all these seats. I don't remember how many seats it was, like 80 or something. It was a nice haul, per plane load. But the reality was, it burns such an amount of fuel, and it requires so much more maintenance than a regular plane. And it was only cleared to land at certain places, and blah blah blah. it just didn't work out. And people were protesting the pollution and the noise was becoming an issue. And in France, they actually care about crap like that. You know, and I do think that people are going, the environmentalists are going to start freaking out when Virgin starts doing this stuff on a regular basis, because it's crazy. All this stuff is crazy. In fact, there was an article today about the satellites, which I thought was very interesting. And by the way, this is one of the reasons the Virgin Galactic, they won't go any higher than they're going, because if you go a little bit higher, you start bumping into satellites. What? Wait a minute. Oh. Satellites. Wait, satellites. Kepler, blah, 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 SpaceX. See, SpaceX is launching 60 new satellites. Was it Tuesday? I don't remember. All right. Well, I remember reading it recently. It was an article saying that there are now so many satellites, and now they're launching more, and you're reaching a critical mass of satellites. Control F, SAT. Aha! So this article is how mega constellations could create new natural disasters. And here's the thing. Oh, frick. Sorry. You know, and so this is important too. So like, you know, when I invested in Sirius back in the day, and there was a company called Iridium that was going to be a satellite phone company that we thought was going to be a big hit, but it turned out that it didn't quite work out in the end. You don't think of all these things that could happen. And one of the things that's happening now is there are 8,000 to 9,000 satellites up in the air. 2,000 only are still active. You know, 6,000 are junk. 6,000 are now just floating junk. 300 new satellites in the last 9 months, but then you got things like you know, SpaceX is launching a whole bunch, like 90 or whatever, and these other guys are launching a bunch, and everybody's launching them all over the place. And now they can launch little tiny satellites and multiple ones. But the problem is that, as it says here, with tens or even hundreds of thousands of satellites in orbit, a single collision could trigger a chain reaction. So in other words, what happens is one satellite bumps into another one, and pieces break off, and those pieces start flying off in random directions. They in turn become bullets that fly into other satellites and cause other collisions. And you can trigger an entire you can wipe out like sections. If you look at this, it's a pretty accurate map. So if you imagine like a densely populated part of the satellite belt, that we don't have a satellite belt, plus not to mention the total pollution of the night sky that's starting to occur, where you can barely you can't tell what's a star and what's a satellite anymore. But if something happens to one satellite, so I'm not talking about a meteor, we're just talking about one satellite goes off course and hits another one. It bumps in, that one breaks, it slams into another satellite, pieces break off, then another satellite gets hit and pieces break off. And all of a sudden, it's like they're all banging into each other and smashing into each other. And you can knock out a whole section of the satellite sky and cost billions of dollars of damage to all these companies. So there's going to be a whole thing now. But now, on the whole, though, that's good for somebody like SpaceX, because they're going to be involved in the effort to clean this mess up. But it doesn't matter, because people are still launching new satellites all the time, and apparently you don't even need permission anymore. Oh, Starlink alone proposes 42,000 satellites. That's freaking insane. We only have 9,000 up since we started putting satellites in orbit. These guys are going to put 42,000 satellites up, and that's just one company. You can't stop the other companies from doing it. And they're saying also that the reality is any major solar flare can knock out a whole bunch of these satellites and put them off course and hurt their guidance system. If that happens, they will start smashing into each other. Anyway, it's a good article. And that was in yesterday's thing at 8:19 a.m. Oh, that's why I was confused. It was this morning, but it came out in yesterday's post. Until I published a new post, the news keeps coming out in the old post. But it's a good article to read, but it's the unintended consequences of the things that we do and the hype versus the reality of what actually happens. So, you invest in a company putting up 42,000 satellites and go, yeah, we're going to dominate the sky and blah, blah, blah. But then, 5 years later, those satellites, like 10%, 20% of those satellites get knocked out of orbit because something happens and they're damaged. And now the company's entire network is down. It's like, well, we expected to have some redundancy. That's what they'll come on TV. You'll hear these words one day. Well, we thought we never anticipated having to have this much redundancy in our network. We were prepared for even 100 satellites to go down, but when 2,000 satellites or 3,000 satellites go down at the same time, I'm sorry, but we can't function. We're not going to be able to function until we can get back in get satellites back up in orbit, which will be months, and then boom, the whole company collapses. It's just like every technology. People don't take it seriously. They don't look at the warning seriously. They just go ahead and build stuff just because they can. And honestly, not even just because they can, but because people are willing to invest in it. You're willing to give SpaceX $35 for a share of stock at a valuation that is completely insane. And the same goes with Tesla. Who the frick is giving these people $900 a share? It might be 1,000 now. Let's take a look. It was 9 something when I looked last. Let's see. TSLA 920. Oh, it came down a bit. Okay. So what was that? NQ? I mean, it's such a joke. I mean, and it's not the 920 per share. It's the fact that you're getting close to $200 billion in valuation for Tesla. Or can't be that much, right? Wouldn't that be awful? Over 100. I mean, it's hard to keep track. It's so yeah, it is. Look, $168 billion. It's how do you even imagine that? How do you keep this in your head? Here's Tesla's financials. Now, notice, look, 24 billion in revenue. And by the way, there's an issue with these aren't sales. These are revenue, but a lot of this revenue is income credits from the government for selling the solar cars. That they get these credits, so those are petering out. Their actual car revenues are down significantly from last year. Their gross profit $4 billion, same as last year. No growth, no real growth here. R&D went down. SG&A down a little bit. Overall, they're just showing about a $1 billion loss basically for the company, and they are valued at almost $200 billion, just like Toyota. Oh damn! It's going to be priced in yen. You sons of bitches. How do I make a point if you're going to price your freaking stuff in yen? Does Yahoo price in yen? I was going to show you side by side, but how do you do side by side when one's in yen? Toyota Motor financials. Yep, yen. How ridiculous. I think it's yen. Oh, hey, maybe it's dollars. Maybe it's just such a high amount of dollars it's blowing my mind. No, that's yen. So clearly they're telling you it's in yen. Oh, here it is. Currency in yen, all numbers in thousands. Oh, well. Okay, thousands. This is very confusing math then. Ugh, what an annoyance. Trying to make a nice point to show you guys something, and I can't do it. All right, you're all smart people. Let's see if we can do this. Stop showing me Toyota, Tesla. Where'd Tesla go? There they are. Okay. Okay. Hopefully this doesn't break your brain, but it's okay. So there's about 100 yen to a dollar. So in other words, but these are thousands. So this is 30 billion yen. Wait, 30 billion yen. If we take 2 zeros off. No, those are millions. Oh, wow. It's trillion. Oh, if it's 30 trillion, it's 300 billion. That's right. Okay. Just imagine that number. That's $300 billion in sales. That sounds like a crazy number. That's probably right. $300 billion in sales. $188 billion in net profit. And, oh, that's net. That's not even operating. That's freaking 18 billion? I don't know. Does anybody have any idea what the hell I'm doing? Iridium 331. That's funny. I gave up on them. I gave up on them in the fives or something. All right. So where were we? Yen. I don't know. Why can't I do this math? Okay. So first of all, it's 30 million times 1,000 at least. It's 30. That would be 30 billion, but it's not 30 billion. There's no way. So it's times another 1,000. It is a million. And that's 30 trillion. Divide that by 100. And it's $300 billion in sales. 180. I can't get around this number though. They can't make that much money. Wow. Getting a headache on this. GM. They're priced in dollars. Total revenue, that's billions. 137 billion. And they make 6 billion. You know what it is? There's something just wrong with this Toyota number. They cannot make 300 billion. Oh no, I see. We're just adding a 10 though. That's what it is. I was just looking the wrong way. All right. So 300 billion in sales, 18 billion in profit. That makes sense. Sorry. Now I got my head on. All right. 300 billion in profits, 18 billion in sales. That in profit, that does make sense. So that's that's Toyota. So Toyota, 300 billion sales, 18 billion in profit. Okay. Tesla, 24 billion in sales, no profit. What will it take for them to get to 18 billion in profit? Oh, let's take a look at the gross profit on Toyota. That's important too. Toyota's gross profit is not here. Really? All right, let's find the income statement. Income statement, income statement. They changed this thing, screw me up. Income statement, thank you. There we go, gross profit, gotta love it. Okay, so $300 billion, 54 billion in gross profit. So 15% gross profit or 20%, or well, 17 whatever percent gross profit. What's Tesla's gross profit? Tesla's gross profit is 4 out of 24. So 1/6 is the same. They have the same gross profit. So don't listen to what they say. Look at what they actually do. Okay? Because you see a lot of these analysts say, but Tesla's margins are so much better than blah, blah, blah per vehicle and blah, blah, blah. That's not true. All right? Toyota has the same exact gross profit as Tesla, which means that you can expect Tesla would have the same operating profit as Toyota after it's all done, after you take the gross profit and put your costs in and so on and so forth. Tesla does not have a special gross profit per vehicle. They don't have a special operating profit per vehicle. They don't have other special things. They're a freaking car company, and the bigger they get, the more like a car company they're going to be. Say the same thing about Netflix. Netflix is a media company, and they're not priced like a media company, but they are effectively Time Warner. And the bigger they get, the more like Time Warner they're going to look, and the lower and lower their margins have to go. So they're in a constant uphill battle to try to they can't grow their revenues fast enough to stay in touch with the pricing that they're being given at the time. Tesla, very much the same. As I said, space, very much the same. When they actually begin to show a profit, you will be extremely disappointed and investors will dump them. Okay, back in 1999, there are dozens of companies, hundreds of companies that are in business today that in 1999 were being given crazy high valuations, like Intel, hundreds of times earnings, AMD, hundreds of times earnings, Cisco, hundreds of times earnings. There were so many companies where it was, oh, no way, now from now on it's going to be this and that and the internet and blah, blah, blah and everything else. And what actually happened? It just turned into a business where you make ordinary amounts of money and you do ordinary things, and investors say, well, what have you done for me lately? And the valuations, the PE multiples of these companies compress and compress and compress. The longer they're in business and the more money they make, those PEs compress. Now, by the way, that does not stop you from making a ton of money now, betting they're going to go to the moon. But as a long-term investment, as a reality investment for something that's not a trading vehicle, that's what I'm talking about. I'm concerned about the actual holding of something for your portfolio or buying it for an actual long-term investment. And as a long-term investment, playing these things is a terrible, terrible idea because they can never actually justify these gains. Tesla, to get to the valuation of Toyota, has to sell the amount of cars Toyota is selling, which is $300 billion, more than 10 times what they're selling now, 15 times what they're selling now. They can't do that without opening 15 times more plants. That's just not how physics works. They're not 3D printing these cars as if, and again, 3D printing is another example of something that had spectacular promise and fizzled out, right? So it's not like you pop a coin in a machine and it prints out your car for you wherever you happen to be. That's not how these things work. Cars have to be built, whether they're built by humans or built by robots. Cars have to be built, parts have to be supplied, so on and so forth. And to grow 10 times or more times where you are now requires 10 times more factories, 10 times more space. Is Tesla opening up a factory every year? Yeah, probably. But they have 3 factories now, and they're going to open up another one in a year. That's 25% factory growth. That's 1 factory per year. So even if they had 2 factories per year, they have to get to 45 factories. And they're going to need unbelievable amounts of money to do that. The amount of money you have to sink into factories and such is astronomical. And so when they tell you, oh, we're going to be able to drive that internally, it's a lie. Because they can't, the revenues are never going to get there that fast. And right now they're being subsidized and so on and so forth and blah, blah, blah. And and the car companies are being very quiet about it right now, which is interesting, but they're all going to start screaming murder, and they're going to start complaining to the other countries that you know, what it is the auto companies now all expect that when they start putting up electric car plants, they're going to get subsidized and they're going to get all these tax breaks and so on and so forth for all this. So that's what they expect now. If it stops, if they don't get it, so when Tesla gets $7,500 per car as a credit, all the other car companies are like, yeah, go Tesla, because they want to get their $7,500 credit. They're not going to scream about it right now. God forbid, though, the government starts saying, no, well, we've decided we can't really support that kind of thing. Those auto companies are going to freak out and demand that Tesla be treated the same as everybody else. Tesla has huge advantages in that every time somebody buys a Tesla, they get a $7,500 check from the government. And those are already fading out. But that's been driving a lot of their revenues. And also the environmental credits that Tesla gets for selling the cars are going to dry up. And that's been a big portion of their income. So it's a very distorted view that you have now of what their profits really are, because they involve a lot of government subsidy. And again, I say the word profit loosely because it's actually $1 billion loss. But this is true of a lot of these companies. That's what they have in common. They have in common the premise that there's some incredible future down the road that's going to be realized. And then, unfortunately, if you actually buy these things and hold them for a long period of time, the chance of actually getting to the promised land is very, very slim. So let's see if we have any questions. $10.20 says I like the original better. Yeah, I don't know what actually happened to that. For some reason, we had to stop using it. Roy says a 90-minute flight costs $250 back on December 13th, blah, blah, blah. A 90-minute flight for SpaceX might be 90 minutes, but it's only 20 minutes in space. Might take you, whatever to get there and whatever to get back. Iridium. I didn't know Iridium was $31.30. That bothers me. I bought him back at like $1 or something, and I got rid of him at $5 because it was so iffy. They had such a hard time getting up, but it was a good idea. It seemed like a good idea at the time. I think they now use their satellites for totally different things. They're not for phones anymore. And that was actually my logic in buying Sirius. Was I was like, well, even if the whole Sirius thing fails, you still have a network of satellites that they can sell. I said there's a lot of things you can do with a bunch of satellites back then, because having satellites that went around the entire planet was actually a good thing. It was something you could sell. At least you could sell it to a cable company or something. So nowadays, everybody's got a satellite. You're really a loser if you don't have a satellite these days, as a tech company. Remember, there's a whole James Bond movie where the guy had a satellite. That was like the whole plot of the movie was getting the satellite up in space. I forget which one that was. Probably a bad one. Probably a Roger Moore one, because I can't remember it. Anyhow, so what else are we looking at? Let's take a look at our indexes and see how they're playing out. These are what, days? Jesus Christ. Look at this thing. 8,200 to 9,800 is 1,600. That's 20%. Is a 20% run in not even 3 months on the NASDAQ. And I guess these guys probably aren't too far behind. Well, about 10% on the S&P, and 7 to 9. That's not 10%. That's 27.5. If we added 27, there would be a 3 something. But if we added 13, wait. If we added 128.29, it's about 7.5%. Yeah. So 7.5% there, 20% there, 10% there. Russell, well, actually, the Russell was kind of ahead of itself in December. So let's say 16 to 16.95 is 1/16. That's not very much, is it? 1/16 is like 8%. So let's say 7 or 8% there. All right. Oh no, I'm sorry, 6%. 6%. So the Russell is actually very much lagging the other indexes, and so is the NYSE. In fact, Sean Luke did a chart for us this morning, so let's take a look. There we go. Why is it so huge? All right. The NYSE. So in December, well, actually in early December, we were here. Oh, actually, it's easy to see here. These are 2.5% lines, so that's 2.5 and not even 5. There's no Russell chart anymore. So we had a little dip down, came back, dipped down, came back. Probably dipping down now, I think, although not today because Dow's up 143. So that puts the Dow back to where it was yesterday, which is about here. What's the number on the Dow? Oh, I missed it. Anyway, so the Dow's back up about here. NYSE is up probably 50 points from here, so about here maybe. But still, it's a weakening. The trend is still weakening. I think we're probably going to test that 50-day moving average at some point. Maybe this will hit 14,000 and this will hit 14,000. We'll get a nice test. And if it bounces up, then it's still bullish. But, you know, you have this pattern forming. They're all curling over, except, of course, the NASDAQ. But that doesn't mean the NASDAQ isn't just behind these guys and is ready to do one of these. So we don't know. And I mean, shocking that Apple had a bad day yesterday and the NASDAQ just went up anyway. It's just, it's not stopping. You know, the top 5 stocks are basically worth $5 trillion now on the NASDAQ. That's, the whole index wasn't worth $5 trillion, I think a year ago. It's crazy how much it's gained. So we'll see how long it lasts, but you know, we got the virus thing, but nobody seems to care about that. Let's see if that's oh, I only had this today. I didn't link it. But we're not going to worry about that. Anyway, so this is, look, the bottom line is this is your infections. And it's just like any chart. If you smooth it out, we're still on this exact track. So you have, if you go up here, you dip below, and now you went above. But basically, this is your track. These are just, you know, aberrations. If there was a candle chart, you'd see the clear trend going just straight up that way. It's not stopping yet. It's the same thing. There's a moving average to this chart too that goes like this, right? And if it crosses below, that's good. If it doesn't cross below, if it comes to that line and bounces back up, we got some problems because we're bouncing 80,000 people infected. These are the number of people recovered. That's a very slow chart. That's a much lower, that trend is clearly this way. This trend is that way. More people are getting infected than are recovering. You don't declare an emergency like this over unless more people are recovering than are being infected. Right? That's logical, right? We should at some point see more people. It's like a death cross, right? You got to see more people who are getting better than are getting sick. And then you can say this thing's under control. But until you have that, to act like everything is fine is insane. But what can you do? That's what's happening right now. So we have to, all we can do is like sit back. In times like this, you got to let it play out. And that's funny. Oh yeah, I was just talking about that with a friend of mine, Mike, who owns Trade Exchange. That's well, let's see if they have a Trade Exchange. Oh, I think did we talk about this last week? This is ready to go. So you guys, download this because Mike's going to do a webinar with us soon. On the App Store, on Google Play, it's Trade Exchange. Look for the little bull guy. So Trade Exchange, and there's an app, and you can go to the site. You can go to this site, and I'm sure if you click on that, it takes you right to the right place. Get actionable trade strategies for stocks, options, and cryptocurrencies. And it's going to be from people like me who are going to tell you, we're going to send alerts to the phone, and you'll be able to make the trade. You'll get an alert from the people you follow, and you will see the trade come up on your screen. If you like the trade, you just push a button. It'll be linked to your broker account because you linked it, not because it's automatically linked. But you will link it, you link it to your broker account, and then when it comes up on the phone and you want to make the trade, you say, oh, boom, make the trade, and it goes right to the proper thing on the broker account, sets up the trade, and all you have to do is execute it. So it makes it very, very simple when you're on the road and very, very simple to manage things so you don't miss any trading ideas. You get a lot of new ideas from different people, and we're looking very much forward to it. It's just about getting ready to go. So it's already available for downloading. That's the key. So, and Mike will be on to do a full demo probably in a week or two. Maybe I'd say probably in March. So what was I actually looking for though? I forgot now. Damn it. It wasn't that. All right, somebody tell me what I was talking about. We were gonna look at something. Oh yeah, don't forget the Fed's coming up soon. We'll see what the Fed minutes look like. Damn it. Why did I get sidetracked like that? What happened? I'm gonna have to review this and see where my mind went. This is the moment that Phil went senile. All right, meanwhile, oil report, February 7th, and this is February 19th. No, that doesn't make sense. This cannot be the current report. What's today? Today's Wednesday. Oh, because of the holiday, they're probably not doing the oil till tomorrow. Oh well, so we're not going to look at the oil. I was talking about trade exchange. We were talking about Tesla. I forgot. I'm sorry. Whatever I was going to look up, I totally forgot. And nobody's helping. I guess nobody was paying attention anyway, so it doesn't matter. All right. Let's go take a look at the Fed. Is that what I was going to look at? FOMC. Meeting minutes, whatever. All right, so the minutes of the January 28th meeting will be coming out soon. The next meeting is in March, and we will see what happens. I have what are my short positions? Trade active. Oh, there's the NASDAQ. Yes. So the NASDAQ down $5,000. Nice. So the average is 97, and we're at 97.36. So I'm sorry, it's not the average. What I accidentally did, I accidentally hit the wrong side, and I sold the two that I had. So I took the loss there. That's the, I don't know. It's all wrapped up in the profit and loss for the day. So it's worse than it looks because my average is not 97. That's just where I rebought my my position at 97. I got the fill at 97, but I took a that was a long time ago too, way back here. So when I went to add them in, I hit the wrong side, and that's what happened. So that's why there's two bought and then 4 short. I had to put the 4 back on. But the bottom line is that's probably accurate. I took the hit of $2,000 something at the time, and my profit and loss of the day is probably correct. But the profit and loss for the open of these positions is understating it by the extra $2,700. This one's not going so badly. The ES is, but I'm not going to add to it, and we'll see what happens after the Fed if it's worth pursuing. What's this? Oh, that's ES twice. That's why. Wait a minute. ES, NQ. Oh, it's a Russell that's missing. RTY. Okay. And the Russell, I had said 1695 was going to be my shorting target there too. But again, I already have these. Those are in pain. If I'm going to do anything, I'd rather average these to a higher amount. But I just don't see it. It's just, I don't know. I'm not going to do anything today. I mean, if it comes back, I'll go back to my 2 and be happy. I think my break even is probably in reality 96.70. That's where I'm guessing my break even is really. Now, if I added 4 more, my break even would be 9,700, but that's a lot. And if it goes the wrong way on me, that would be pretty disgusting. So basically, after the Fed, if it's going the wrong way, then and depending on what the Fed says, obviously, then I'd be more likely to add to the position. Now, what do we got here? We got charts. So everybody's tapering off just a bit, but we're coming into the Fed minutes, and I'm sure people are just cashing in and saying that was a good day. and let's hear what the Fed minutes look like, although I doubt they're going to say anything exciting. But they are going to give us, if you want to look what the Fed minutes look like, the reaction of the Fed minutes is probably similar to the reaction of the Fed. So you go back to January 29th, and that would be in Yahoo. And now we just look at the NASDAQ, for example. Whoops, IXIC. And what day do we say it was? January 29th? So what happened on January 29th? Okay, so we were up, but we finished the day lower than the highs, and the next day we went down, and the day after that we went down. So the market did not like what happened on Fed Day in January. Obviously, we more than recovered since then. But there's other factors, of course, like what was the news about the virus and so on and so forth. We're not sure exactly what happened, but the bottom line is that was generally a down day, and it was down 2 days after the actual Fed minute, after the actual Fed meeting. And don't forget, nothing changed in that meeting. I think it was like 3 words were changed in that whole report. So it was a nothing thing. But the bottom line was the Fed didn't give you more free money. And I think if the discussion from the Fed is that nobody's considering putting more money to work in the system, that might be considered a negative. And then you'd have to say, well, how bad did we, the virus wasn't a big consideration at that time. So now with the virus and with China providing stimulus and Europe's providing stimulus, don't you think the Fed should provide some stimulus too? That's not going to show up in these minutes. That's just a speculation. That's why we're up here. It's an excuse for the government to provide more stimulus, and especially the Fed, because it's, if the Fed provides stimulus, it doesn't look like the U.S. is going more in debt or that we've unbalanced our budget or anything like that. Nobody pays attention to the Fed balance sheet, so they can prop up, they can throw another $1 billion into the market, and nobody even cares. But they need an excuse, and this might be an excuse to do it. But you're not going to get that excuse off the minutes, because I doubt they were even really discussing it. But we'll find out, because they're going to go very shortly, about 5 minutes from now. Whoops. Clicked on an ad. We started doing our portfolios today. We have, this was the Money Talk portfolio, which is the one that we only trade when we're on the BNN show. And last time we were on, we added the FCX position and the IMAX position. Both of them are still perfectly good for new trades. Obviously, China is massively depressing prices. Copper, metals. Look at copper. This is the virus impact, right? So right around the Fed meeting, the Fed meeting was here actually. So I guess we were talking about the virus before that. Because it was January 29th, right? So here's the Fed meeting. So copper was already tanking out, and it's just barely recovering right now. Freeport sells mostly copper, also gold. Gold went the other way though. But FCX, where is this? Oh, FCX. So they took a hit along with the copper pricing, basically. People still treat them like they're copper only. But if you look at FCX, I'm pretty sure this had it. I think we talked about this though at the time, right? Because I seem to remember doing this. If you look at Freeport, copper is 60%, gold is almost 30% of their operation. Molybdenum. Oh, that's something I read. Something about molybdenum. Something about it being critical, new battery technology or new solar technology using molybdenum to make way better cells. It's really a big deal, and it was in one of the news reports, but I'm not going to look for it right now. But anyway, what that made me think of, aside from Freeport being having a good amount of it, you got to look at our friends at Northern Dynasty. They are sitting on the largest reserve of molybdenum in the world, and they're waiting to get permits. And this is something that might actually help them get their permits, because this is becoming a critical resource. Now, oh wow, look, so they've been taken off anyway. We talked about them on and off for a long time. They just went from 40 to 60, so that's very nice. And if they ever do get their full permitting, they're going to go up there. This is going to be a 10 bagger at some point. So I like them. It's one of my favorite penny stocks. They've got, again, you guys might have heard this 100 times. They are sitting on the world's largest untapped gold, copper, and molybdenum reserve in the world, but it's up in Alaska. It's up in Alaska, and it's right next to the major salmon fisheries. So they have had trouble getting even with Trump in office, even with the EPA, that basically is attempting to destroy the environment. This is so egregious. The concept of having this gigantic open pit mine where the runoff can kill the entire salmon industry of Alaska, which is half the salmon of the United States, and basically endanger our entire supply of salmon, which people eat a lot of, especially sushi people. That would be a complete, total economic disaster that outweighs any potential benefit of a mine. But now, if molybdenum becomes a bigger thing, the potential benefit of the mine, the necessity of the mine, can be argued that it outweighs the potential environmental disaster. Should the chemicals leach into the soil? Should the contaminate, should the runoff from the mine contaminate the water supply? Those are only potential problems, not definite problems, whereas there's a definite need. And that's what the judge has to weigh. The judge is going to weigh the societal impact, right? What's the societal impact of not having salmon on your sushi platter versus the societal impact of having a cheaper source of power to drive your car and your lights in your home and so on and so forth. That's generally the logic they'll tend to use. So that's going to be helpful to get them their permits, and the molybdenum, and that's a bonus, because that wasn't going to be the main source of income for them, but it could become a metal like palladium, which I guess you guys know has been look at what's going on with palladium. So you're going to see molybdenum start taking off too. And it's going to go up and up if they start using it in electronics the way they're using palladium. This is being driven by the solar power and electric car industry, and the moly is going to start going that way too. So it's going to be very interesting. Oh, minutes. Now it's time for the minutes, right? Let's refresh. Oh, the Fed's minutes are released. There they are. I got to read this. Blah, 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 blah. Look at all these people involved. Wow. Wow. 2 pages of people. There's a lot of people. Oh my God. So what is, oh, the market doesn't like it already. Look at this. Little selling off going on here. What should this be? YM. There's the Dow. All right, so we know that this isn't coming out well. Open market transactions. As reaffirmed effective, blah, blah, blah. So they're continuing the open market transactions. We knew this. To allow eligible securities in the soma to mature, the exchange market price. Nope, just continuing that. Securities lending, this, oh God. What? By unanimous vote, the committee voted to reaffirm the open market operation shown below. So there's no change. All right, good. So we can skip that. It's nothing really particularly there. Readiness testing, the bank undertook transactions described from time to time. All transactions authorized. Oh, nope, that's something else. Nope. Additional matters. The committee authorizes the chairman of the committee. Good God. These are this is unusual for a meeting. This is all a lot of insider crap that we don't really care about. Wow. Okay, there we go. This is what we care about. This is not, they don't usually have all that. That's like a lot of internal crap from the Fed. It's probably interesting. Well, interesting to me. It's probably it's probably interesting to read if you're a finance geek, but basically I don't think it's very important. All right. Participants continue the discussion of the Federal Reserve policies, tools, common practices, focused on topics, potential interactions between monetary stability, inflation ranges, the staff briefing that in the low neutral rates, achieving the dual mandate would require low policy rates frequently, regardless, wait a minute, achieving the committee's dual mandate goals of maximum employment and price stability would require low rates frequently. That's a weird way to put it, regardless of the monetary policy strategy and tools chosen. Consequently, policy strategies and tools to help support a stronger economy and anchor inflation expectations at a level consistent with the committee's objective in a low neutral rate environment can help promote financial stability. In addition, the staff reported that the available empirical evidence suggests that the effects of changes in policy rates on asset prices and risk premiums tended to be modest relative to the historical fluctuations of those measures. Oh, wow. All right. So what they're saying is that they're finding cover because they're basically saying, well, we're not really causing the huge run in the stock market because the stock market does have huge runs every once in a while, and we can't really say that this one is particularly due to our meddling in the markets, or so the artificially low rates that we have, the POMO operations we carry on, the liquidity we push into the markets, that's got an effect, but it's not an effect that's really outside of the normal giant swings in the market that you have. And to some extent that's true, but the historical swings include a lot of Fed meddling also. So I'm not sure I would really buy into that. There may be circumstances, persistently accommodative stance that is otherwise consistent with the dual mandate goals may contribute to an increase in financial system vulnerabilities, including through increased borrowing, financial leverage, and valuation pressures. All these things are happening. There may be circumstances in which a persistently accommodative policy stance, in other words, in the stance we have now, that is otherwise consistent with the dual mandate goals, which is basically bullshit, may contribute to an increase in financial system vulnerability. We have that. We have increased borrowing. We have increased leverage. We have increased valuation pressures. The staff noted the clear communication of the committee's ongoing assessments of the interactions between policy and financial stability could help avoid large interest rate surprises that could otherwise contribute to financial stability. So they're saying keep the rates low or we're going to blow the market up. That's the short version of that. The briefing concluded with a short review of how other central banks have approached the issue. Every central bank's doing the same thing. This is ridiculous. Escape clauses provide leeway for the central bank to deviate from its policy strategy if financial vulnerability becomes significant. In their discussion, the alternate effects, I'm trying to just look for something that's interesting here. Unstable financial system amplifies shocks. Evidence link between policy stance. A couple of participants further observing there were not many episodes of persistently low rates. In addition, some past episodes of heightened financial vulnerability were excessive. All right, so here's people talking about some of the risks. A couple of people are rationally trying to point out that there aren't many episodes of rates like this where you can say that you can't say what usually happens in a low rate environment because this is crazy what's going on right now. negative interest rates and such. In addition, past episodes of heightened vulnerabilities were associated with excessive risk-taking that did not seem to be responsive to typical changes in rates. A number of precedents judged that under some circumstances, low policy rates may help foster financial stability, provided they are needed to support strong economic conditions and price stability. Now, don't forget, when they're talking about price stability, they're saying they have to keep rates low, or like Japan, prices would be dropping. If it wasn't for the very low borrowing rates that consumers are able to go out and refinance their homes and so on and so forth, just like we did in 2008, if it wasn't for that, if it wasn't for repeating the same mistakes we made in 2008, we would have problems already. Just like in 2007, and as the banks began to collapse in 2007 and 2008, the Fed's response was to lower rates and lower rates and lower rates and pretend everything was okay and keep people borrowing, keep people refinancing, even though the entire housing market was about to collapse. And they knew it. Because it's all about buying another quarter. It's all about just getting one more quarter of growth, get one more thing, and they think that's going to make everything all better. And it doesn't. It really doesn't in the end. Some participants remarked, however, that keeping policy rates low to achieve the committee's goal may contribute to a buildup of financial vulnerabilities, especially at times when the economy is at or above full employment, which we are, a development that could pose future risks to the economy and the ability of the committee to achieve its dual mandate. Yeah. But look, the bottom line is if I'm a bull, which I guess I'm not, but if I'm a bull, I'm gonna cling to that and say, well, look, most of the guys on the Fed want to just keep on keeping on. And a couple of guys are saying we don't like that, but Trump's trying to replace those guys anyway. So there's really not much chance the Fed's going to change their policy. They're going to just keep these low rates until the whole thing blows up in their face, and then they'll say, who could have guessed? And this is, by the way, the weird thing about the Fed, because now Trump's proposing these people who are like insane to go on the Fed. And when you have these meetings, what's the meeting about? If the president packs the Fed with people who are all ultra low rates, do whatever it takes to prop up the stock market, who cares about the future, blah, blah, blah. If that's the board of the Fed, then these minutes are going to start reflecting more bullishness for the market, right? Everything you read is going to be like, yeah, lower rates, do this, do that, prop this up and do that, because that's all there is. It's like the Supreme Court, right? If you put all conservative judges on there, then of course they're going to ban abortion at some point. You don't have the votes anymore. You don't have enough. You don't have people with different opinions on the board. It's healthier to have different opinions, but it's not fun for the people who want things to go a certain way. They don't want to debate. They don't want to debate and find the best solution. They want to find their solution. Financial security stability should be incorporated into the monetary policy. Should be primary means. A few participants commented, especially the case when addressing the risks of social structures, current low neutral rates. A number of participants noted countercyclical macroprudential tools, such as countercyclical capital buffer, could be used to address cyclical. Okay. However, various participants noted that while these tools could be deployed proactively to lean against the buildup of financial vulnerabilities, they have some limitations in the context of the financial system where fuel available tools are for the most part not designed to address vulnerabilities outside the banking sector. In addition, these tools are not within the authority of the committee, and they're used blah, blah, blah. Recognizing these limitations, many participants remarked that the committee should not rule out the possibility of adjusting the stance of monetary to mitigate financial stability risks. So, oh, wow, really? So they're saying, some people are saying anyway, that the Fed should proactively tighten policy to avoid financial stability risk, because they are not going to be able to do it fast enough if things start to fall apart. And so they better do it now before it's too late. Now, obviously, they didn't do it at this meeting, and the market went up tremendously since then. So these guys were right, because they said you were getting into an asset bubble. Recognizing these limitations, all right, great. when those risks have implications for the economic outlook. Nevertheless, participants noted current knowledge of the interactions between stance and policy is too imprecise to warrant systemically adjusting monetary policy in response to the evolution of finance. Wow, really? What the hell kind of argument is that? Many participants noted that the current knowledge of the interactions between the states and monetary policy, they don't understand how their stuff works. It's too imprecise to warrant systematically adjusting monetary policy just because you see financial security risks. So until there's an actual disaster, they don't want to adjust. As a result, monetary policy should be guided primarily by the outlook of employment inflation. It should respond to financial stability risks only insofar as such risks threaten the achievement of the committee's mandate. Whoa. Several participants observed that the monetary policy measures in current financial could be quite large and resulting effects on employment inflation could place a high hurdle for such measures. Yep. I like these some participants, but they're on the way out of this Fed. Financial stability risks are consideration for achieving the dual mandate. A clear communication strategy would be needed to convey the committee's assessment of vulnerabilities and their implications and outlook. Several participants noted that the communication strategy should include the possible use of financial instability, escape clauses to help explain the rationale for policy when it build up. Okay, great. So the minority says we're heading to disaster, but the majority says, oh, well, if there's an actual disaster, in other words, we're heading to a cliff and we should do something to like slow down at this point. And that's some people are saying that. And the other people saying, well, yeah, we're heading to a cliff, but we really shouldn't do anything until we actually go over the cliff. And then it would be time to start braking. That's essentially what our Fed is doing for us. Inflation range, blah, blah, blah. Who cares how they communicate? Obviously, the inflation range is a lot of bullshit. Foreign central banks' inflation ranges, these ranges are placed, blah, blah, blah. A range of views on benefits and cost of different types of inflation. Okay, so they're talking about maybe they're looking at inflation wrong, but they're not. Development, they are looking at inflation wrong, but in ways that's not being discussed here. The most egregious thing about inflation targeting that the bank uses is if my iPhone was $1,000 2 years ago, and now it's $1,400, but my $1,400 iPhone has 256 gig of memory, and my $1,000 iPhone had 128 gigabytes of memory. So the Fed says this iPhone is twice as good. They take into account the processing power and everything else. But the Fed will say, sure, it's still an iPhone, but it's a much more powerful, faster iPhone for $1,400. It's twice as fast. So you only paid 40% more, but you got 100% more phone. Therefore, you saved 60%. Congratulations. You spent $1,400 on your iPhone, but we're going to count that as a 60% decrease in price because you should have paid $2,000 for your iPhone so let's say you saved 30%. So you saved 30%. You had 30% deflation because you have a twice as fast phone as your $1,000 phone, but you only paid 40% more. So you didn't spend 40% more. We're not going to count it as 40% inflation. We're going to count that as 30% deflation. Doesn't matter whether you asked for 256 memory. It doesn't matter whether you wanted 3 cameras instead of 2. It doesn't matter whatever other crap they put in and how much more free software is in the thing. It's about the way they count it. And they count that with everything. If you get a faster car, if you get better mileage, if you get more horsepower, if it comes with the leather seats, they consider that. If the car costs this much more but has this much more stuff in it, they're like, that's not inflation. It goes to anything in the, a lot of things in their list are like that. If if your oven is better, if your this is better, they don't count the price increase. They say, here's how much economic benefit you're getting from your better oven compared to your old oven, and therefore you're getting deflation, not inflation. And that's basically the whole problem with all this bullshit, is they pretend there's no inflation. And then when something inconvenient like college goes up 50% a year or whatever, and housing goes up on you and rents go up on you, they say, well, those aren't really counted because it's a one-time thing. Like college doesn't count as inflation because it's a one-time thing that only happens once in your life and then it's over. So we minimize the impact of your college, even though obviously it becomes debts for people's entire lives. So there's a lot of that bullshit in the inflation. That's why I'm saying it doesn't matter what they're talking about here. It's all crap. Their whole way of measuring inflation is crap. As anybody who has a friend on Social Security or a parent or something, you know it's crap, right? You know that the Social Security checks are useless these days. They used to pay for somebody's entire retirement. You know, people used to retire quite comfortably on their Social Security checks. Now, well, not comfortably, but I mean, you used to be able to go to Florida and live in a small apartment and eat, you know, like that. It's like if that was your only source of income, you could still live with some dignity. Now it's not enough to cover anything. It's just completely ridiculous. And that's because the government, obviously, to mask how little money they have in Social Security and how much fast it's running out of money, they basically just keep under measuring inflation in order to be able to say the cost of living adjustment should be much lower. It also helps you justify paying low wages to people, not giving people raises, even though corporate profits. It is amazing when they shout record corporate profits, but wages are nowhere near records. Because again, because you don't need it. That's what they say. They tell the workers, you don't need more money. Look, there's no inflation. Why do you need a raise? That's how they justify everything. So, you know, when everything is based off a massively false premise, what's the point? Developments in the thing, signs of reduced risk to outlook, favorable data, economic, final few days of the, over the final few days of the intermeeting period, financial markets responded to news of the spread of the coronavirus starting in China, which reportedly contributed to downward moves in treasury yields and to a lesser extent, U.S. equity prices. Remember that little pullback we had at one point? That's what they're talking about. On balance, U.S. financial conditions became more accommodative over the period, with equity prices rising notably. Despite signs of reduced risk and outlook, some stabilization in the economy, financial participants' views on the, I mean, obviously it was the wrong time with the virus looming. It was the wrong time to raise rates right then. But I think that completely ignoring the virus and just getting, and it's just such an indication that we're in a ridiculous asset bubble that you would think the Fed would have to act at some point, but it's hard. I don't see it. Not with the way they say many and some, and the some seem to be like losing every battle here. Market-based indicators point to expectations, target range, blah blah blah. So there's an article today about the virus is going, which was my original estimate. The virus is going to knock $1 trillion off of global income, which is basically exactly what I said when it started, and that's 1%. So it's going to knock 1% off the global GDP basically. And global GDP is usually 3.5%. It's probably going to be about 2.5%, but that's a big 1%. It can really hurt a lot of countries. A lot of countries just need a lot more growth than that to get going. Yeah, this one also, America too. The next review, desk operations. Since the year end, the money market rates remain stable. Reserves are projected at 1.5 trillion. No one cares about that. Manager discussed potential plan for gradually transitioning. Second quarter expects. There's a lot of inside crap on this meeting. Briefing, technical. All right, economic situation. That's what we want to read. How long is this? I'm getting tired of this. Oh my God. What is going on with these minutes? Holy crap. Consumer price inflation in the price index for personal consumption remain below 2%. There is no inflation. That's what they're telling you. There's no inflation. Total non-farm payroll rose in December, solid pace of gains. Unemployment held steady. Private sector job openings declined, but was still at fairly high levels. The rate of quits was at a high level, which is good. That means that people are comfortable in their jobs and whatever, and they quit a lot. the 4-week moving average. Nominal wage growth was moderate, with average earnings increasing 2.9%. Total consumer prices increased 1.5%, ending. Core PCE was 1.6%. Consumer price inflation was lower than core inflation. Energy prices declined, right? That's a big thing. The trimmed mean measure, PCE, core CPI 2.3%. Recent readings on survey. Long-run inflation expectations were a little changed. Michigan consumer confidence is through the roof. Michigan surveys consumer measures. Next 5 to 10 years move back to in early January after falling to the lowest level on record. I don't remember Michigan being so low. Meanwhile, the 3-year ahead measure for the Federal Reserve New York bond remained historically low. That's interesting. I thought consumer confidence was high. I'm confused about that. PCE appeared to have risen more slowly. Key factors influence consumer spending: the low unemployment rate, the upward trend in income, high levels of net worth, generally low interest rates, supportive. In addition, the headings on consumer confidence for Michigan was strong. So consumer confidence is strong, but they're saying the Michigan survey was low? I don't know. I'm going to look at that more closely. Residential investment appeared to have increased solidly. Building permit issuances are rising. So the economy is on pretty solid footing. I mean, you can't argue with that. It's just that the market's price for this trend to go, we're recovering from a recession, and things are looking up, but they're not going to just keep going up and up and up. We're going to level off at some point. 737 max restraining investment, nominal business expenditures, crude oil, natural gas rigs. It's interesting to see what kind of stuff they look at. It's the same stuff we look at generally. Industrial production increased on net. Industrial production was lower than a year earlier, with declines in manufacturing production, output and utilities, partially offset by mining output. Automakers suggested assemblies on light motor vehicles would increase, but that gain is likely offset by Boeing's curtailed production, and also it's going to be killed now because of this virus thing. Total government purchases appear to have increased moderately in the fourth quarter. Nominal defense spending, blah, blah, blah. Nothing there. Real net exports estimated to a substantial boost to GDP growth in the fourth quarter. Available monthly data suggests imports fell significantly. That's true, because our net exports are way up because imports fell a lot because of oil. When oil prices go down, that's our biggest import, obviously. Incoming data suggests that foreign economic growth slowed further in the fourth quarter, very subdued pace. The advance. All right, so what's changed? You have to think about that. Like, what's changed since then? Well, now everyone in the world, Europe and Asia growth is really fallen hard in the first quarter. It's a big problem, but that's not a bad thing. If you're bullish, then that's great, because it gives the Fed reasons certainly not to raise rates, and reasons to ease, if anything. So even though the U.S. economy is essentially unaffected, the fact that there is a huge problem going on in Asia and there's a huge problem going on in Europe means they're very unlikely to raise rates. And that's why you're seeing the TLT, the 10-year treasuries, and actually TLT is 20 years. But that's why you're seeing these rates on the treasuries. Now, what happened today with the rates? Let's see. Yeah, so we're coming off the highs there on the 10-year and the 5-year. High is lower rates. The rate is lower the higher they go. And we'll see, and that means TLT should be coming down, which we have a short on, so that's good too. You just made an adjustment on that, in fact. Well, it's coming off of this. We're betting it's going to go down from here. That was one of our adjustments in the portfolios today. All right, so on the whole, there's nothing that exciting, no big changes, and the Fed just is going to stay the course. That's basically where we are. Okay, Mark asked if I covered LB and the ex-dividend. I don't think we even have LB anymore in our portfolios, frankly. But let's talk about it. So apparently LB paid their dividend. LB, who had really taken off a bit, And he says ex-dividend, so let's take a look and see if they went ex-dividend. LB. I think our portfolios are currently LB free, unfortunately. Oh, no, one of them has it. We definitely went long the LTP or something. All right, so dividend date was, or is tomorrow. So tomorrow they're going to pay out 30 cents, big deal. I mean, it's basically, it'll probably knock the stock down 30 cents. I mean, that's what happens. They're giving away 30 cents worth of cash, and that'll correct the stock by 30 cents. But it's not a big deal. So in other words, 30 cents a share. When somebody pays a dividend, what happens? They're going to pay 30 cents, which is a nice dividend. The stock's at $24.43 per share, and they are going to hand you 30 cents per share as a dividend. Therefore, tomorrow the share would be worth $24.13, basically. Now, that gives it a little bit of downward momentum. There are certainly people who are holding the stock, especially at these highs that it's come up so nicely. There are people who are holding the stock and are holding it until they get the dividend, and then they're going to get the hell out and take their profit, because a lot of people came in at 18, and the stock is now 50% higher than where a lot of people came in. So it's very possible that it goes down. So I don't know if you have an actual question on that or anything, but we don't do anything about that because we don't really care. It's this happens with dividend stocks, and there's nothing you can do about it. And well, I mean, you could do something, but realistically, what do you want to do? Because we were at $24.45. The $25 puts are a ridiculous price. No, you're certainly not going to sell those or buy those to cover your stock, right? The $27.50 puts are $4. That doesn't make any sense. So there's no way to protect yourself from this. It would be idiotic to buy puts. Frankly, selling a put's kind of fun. So if anything, I think I might want to look to sell something. We've been hoping LB pull back so we could add to the position, but we haven't so far. Oh, that's not what I wanted to do. Charts. So how are we doing? So a little bit of disappointment from the Fed, but now it's all over and the market's heading back up again because, like I said, honestly, it's basically bullish. They're saying they have no intention of doing anything to tighten. So who's going to be upset about that? Wow, look at the recovery in oil and everything. Very nice. We have a long on that, so that's good. Copper had that nice bounce after testing the lows again or getting low again. But like I was saying about the futures, so the energy, we got this huge recovery from the lows. So that's almost all water under the bridge. On a daily basis, we were way down here, 145, 55, 50. We played this long. We already got out though of these trades because we weren't sure what's going to happen with the virus, and everybody's acting like it's all over. I don't know that it is, but certainly everything's acting like it's over, so we won't worry about it. On the sauce, we got coffee, just getting a little pause at 110. No big deal. Sugar really took off and finally pulled back. The metals we were just talking about, that's where they are. Meats, see, and the virus was going to stop China from buying the hogs and such. And look at this, that's crazy. That is a crazy drop. So it was actually kind of a good buy down here because that's all virus fear. Boom, 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 boom. Like started flying down and now coming back up a bit because maybe people from China are going to get out of their homes and start doing things again. And meanwhile, for good or bad, that's going to happen. The government is telling people, let's get back to work and start doing things, even though they don't really have the virus 100% under control. They just, at a certain point, you're like, well, it won't matter. It doesn't matter if we get the virus under control if we have no economy left. so this is like week 3 of shutting China down. Yeah, basically, this is the 3rd week of China being basically shut down. So they got to get people back to work, and so they're trying to test and do as safely as possible and get people back together. But unfortunately, if they miss one person, if one person slips through and ends up infecting 1,000 other people at a factory or whatever, this whole thing can start up all over again. That's why I'm not willing to say it's safe to jump back in yet. I mean, just too many possible things can go wrong, and also the repercussions of the virus are basically being swept under the rug, and China's very good at sweeping problems under the rug, but it's going to come out in the earnings reports, it's going to come out in other things. There are deals that people have with Chinese companies that flat out have to be canceled. You know, the state can't cover every single thing that went wrong in China. They can't, you know, if there were M&A deals that were supposed to go through, if there were checks that had to be written for things, you know, China can't just sit there and fund every single problem from the virus that companies have. You know, buildings that have to be paid for, you know, mortgages and so on and so forth, the bad debts in China. Obviously, if people didn't work for a month now, the two possible ways this can go. Either the people didn't get paid who didn't work for a month, or the factories didn't pay. Either people didn't get paid and the factories are not so bad, or the people are suffering tremendously. You don't get paid for a month unexpectedly, you're going to be cutting back for ages, not just today. You're going to cut back for a long time. If the factories or the employers didn't pay people for a month, they'll be okay. But if the people did get paid and the factories did put out the money and they didn't have the income coming back in, they're going to get hurt. Somebody's going to get hurt. There's no way nobody got hurt in China with all this going on, and it's very unlikely the government's going to be able to paper it over in a $14 trillion economy. If you lose $1 trillion, you can't fix that very easily. It's messy and it would take a long time to fix it. You know, our entire TARP was $700 billion, our bailout of the banking industry in the United States. China was telling the banks to keep making loans during this problem. Now, they're going to have to cover that. I mean, it was implied that they would, but they're going to have to somehow cover that. It's going to be messy. So look at the dollar, still super strong. Now, that makes actually the market gains more impressive, though, because we're doing these gains against a super strong dollar. Europe is completely collapsing. They've gone from 130 to 108. So they've lost 20. They've lost, I want to say not 130, 113. 113 to 108 is 5. So it's 4% maybe on the euro has dropped since the beginning of the year. That's nasty. It's a 4% drop. We're up from 96.50 to 99.50. We're up about 3%, basically. Look at Japan. Because Japan has the most viruses right now out of anybody. Not the most total, the most growth of viruses out of anybody. They're getting a huge uptick in viruses. They are not well contained. They could be the next outbreak. So what do we do if Japan's economy hits the skids? And Germany's already in a recession. So, you know, I don't want to dwell on negatives, but everybody's being so positive. Somebody's got to bring up the goddamn negatives. It's crazy. So where were we? We were looking at the money to our portfolio. I remember that. I think that's where we got sidetracked before. We added FCX. I was going to talk about that. I showed you Northern Dynasty, and that's what made me think of that. SunPower has had a rough time. Oh, I love SunPower, and they're good for a new trade again. SunPower was doing much better and got killed. SPWR. Yeah. So I'm sorry I didn't get that yesterday, because look at that. They flew back up from there. So SunPower got hit hard and came back. Gold is Barrick Gold ABX obviously having a very good time with gold prices flying up. IBM is obviously, like I was just saying before, it's like they don't get enough respect for being such a phenomenal company. And IMAX, of course, got totally crushed. Also, fantastic trade. Right now would probably be my stock of the year. IBM is our stock of the year. IMAX, I think, would be my stock of the year right now, because this is crazy. They have dropped to $17. I think they're even lower than that. IMAX. Yeah, they've dropped to $17 from 21, basically from here because of the virus. You know, yes, I don't think we're gonna have the box office here we had last year. We don't have as many big, huge movies coming out. Disney's Marvel stuff is basically on pause at the moment. There'll be a lot less this year than there was last year. Nonetheless, though, This is really virus oriented, and this drop will obviously, that's going to go away. At some point, people are going to go back to the movies and this will go back up. It might not be, look, if we have more of a virus outbreak, this can stay down and go even lower, but at some point, they have a very dominant market position. I don't see them going down. So it's a long-term trade, and this one's very conservative. We have the 15-20 bull call spread, the stock's at 17, and we have the short 18 puts with the stock at 17, and the net of the trade is 66 minus 24 is what, 22. So the net of the trade is about $2,200, and it potentially pays $10,000. I think it's a fantastic trade. Oh, and that's only between now and September. So if IMAX recovers over the summer, as I think it will, because that's when the movies come out, if IMAX recovers over the summer, gets back over $20, this thing will pay $10,000 back on $2,200 in 8 months. I mean, that's a great way to play. 7 months now. It's only 7 months. So that's really good money really fast. Oh, that's the other reason IMAX didn't become a trade of the year, is because it's only short term. So what else do we talk about today? All right. Oh yeah, we did make this trade. We bought 3 of the Tesla April 1000s, $80. That's $24,000. Sold 4 of the March 1000s for $60, also $24,000. So we bought 3 Aprils, sold 4 Marches. Marches obviously expire faster. And so as long as Tesla stays below, below 950 for sure, the March calls will decay much faster. And we sold more premium. We sold 25% more premium in March. So the idea is just that the March calls go worthless, and whatever the April calls have remaining in value is going to be our profit. Now, even if that ends up being $20 from 80, if the March goes worthless and we have $20 here, that's going to be a $6,000 profit on a zero cost spread in a month. All we have to do is wait for the March calls to expire worthless, assuming they do. If they don't, we can roll it and deal with it. But I mean, right now, that's where we are. I mean, if you think about it, okay, let's say it goes up and the March 1000 calls go to $100, okay? That would be because the April 100 calls would also go up, right? They would go up at least the same as the March calls, and they're not decaying as fast, so probably do better. But the April 1000 calls, let's say these go to 100. Let's say these only go to 120. All right. Then you'd have 3 times 120 is $36,000, and you'd have 4 times 100, which would be $40,000. So you'd have a net 4,000 loss. But you don't have to take that loss. You could just buy one more April call. All right, for 120. Which would be $12,000. So now you've spent $12,000 on the trade. Now you've covered your March calls, and then you roll the March calls to a higher strike in April, and now you have a bull call spread that's fully covered. So you would end up spending net $12,000 to be in a bull call spread. I don't know what the amount would be, but let's, for example, so we're running this in the short-term portfolio just because it's the great thing to take a look at. But for example, if the March 1000s, where are they? Jesus, oh, you have to go so far. All right, so if the March 1000s are currently $50, then the question is, what April calls are currently $50? And that's going to be the April. So the April 1100s. So in other words, if Tesla goes over 1,000, and like I said, the numbers are whatever they are, doesn't matter. But basically, there should be kind of a proportional move between the April calls and the March calls. So these things should stay as the right roll from the March 1000s, you can roll to the April 1100s. That means we would have a $40,000 spread that we paid net $12,000 for. Because like I said, you would buy one of these guys if they hit 120, and that would give you coverage. You'd be fully covered for $12,000, and then you're in a $40,000 spread. So if Tesla keeps going up, the contingency plan for it is really not bad at all. Now, I think that's ridiculous. I can't imagine that happening. I would be completely shocked if we end up having to spend $12,000 to buy an April 1000 call because Tesla's over 1,000 before March expires. That just would be ridiculous. But if it's ridiculous and it works out, we'll make $28,000 doing it that way. So bring it on. That's why I like the trade, though. The escape is fine. Short-term portfolio. Oof. Yeah. Got killed, right? Because of Tesla. Because look at this Tesla trade. We have 6 short, 900 calls. We sold them for 192. Well, it doesn't matter. Anyway, the net negative to our portfolio on Tesla is $130,000. All right. So at the moment, we're showing a big negative. If, however, so we have $179,000 in cash, but we have a net negative here implied of $130-something thousand. If Tesla is below $900 in September and above $550, then we will make $130,000. That would be would be at $200,000. So we'd be up 100% in the portfolio. So this portfolio is very, very hinged on this one trade at the moment. I don't like that, but it's just the way it worked out. We have a Chipotle trade here. We have a China Mobile here that was an offset to this FCX short, the FXP short that's not working out. SQQ is another hedge. This, that short-term portfolio is for hedges in case the market goes down. The market's going up and up and up, so of course it gets killed. We have a TLT here, not doing good either. Tesla natural gas is not even, is good for a new trade, and oil is doing okay. It's on track. You'd still trade it. That's a bullish trade on oil. And here, all oil has to do is get to 12. It's at 11 now by July, which is, I think, ridiculously conservative. But if it does that, then this trade will pay $6,000. And what do we pay for the trade? We paid $3,000 minus $1,000. We paid about $2,000 for the trade. So it'll pay $6,000. It's not in the short-term portfolio. We're generally using it to hedge the long-term portfolio. These are all things that are going to make money if the market goes down, or short-term trades that we like. There are also some of these trades, like the Tesla trade I just talked about, the proportional Tesla trade we were just looking at. Some of those trades go into the short-term portfolio for the lesson. So all we were doing here with natural gas and what we were doing with USO, these are for the lesson of saying this is how you would trade this in this situation when both of these commodities came down so much. And we put very conservative plays in. Look at this one. The UNG play is a 13-15 spread. UNG is already at 15. All it has to do is not go down, and this trade pays $8,000. And how much was the trade? Basically zero, net zero. 12 minus 8 minus 37, $300. So this $8,000 trade, we spend $300 in. It's already 100% in the money. And all UNG has to do is be above 15 in January, and we make $7,700 on a $300 spread. That's how you play the market. You don't have to take huge risks. That's a very conservative way to play. And you're going to make 10 times your money, 20 times your money. Wow, that's really good. So here's the adjustments. We had a couple of adjustments to make, but nothing big. This is what butterfly portfolio. The butterfly portfolio, on the other hand, made as much as the short-term portfolio lost. It made $27,000. We cut back on it. We decided to cut back our Apple position because we doubled down on it because it was down, and we felt that it would come back. It did come back, and now we said, well, great. So it came back. So let's get back to a more reasonable amount of Apple shares, then get back to playing where we sell and make premium. While it would be fantastic for this Apple trade to pay off because it's 70 times 60 is what, $420,000, and the net of the trade right now is 595 minus 333 is 260. So this 260,000 will become 420,000 if Apple simply stays above 310. That's a big freaking gain. That's almost a double, and a double of a huge amount of money. But having seen a $27,000 swing in that trade in a month, we don't like it. It's too volatile for the portfolio. So we're going to cut it in half and take a lot less risk. And so we'll still make, I don't know, whatever. We'll still make about $100,000 on the trade if all goes well, plus whatever money we make selling short calls while we're waiting. And that's plenty. Just because we can make a ridiculous amount of money doesn't mean we should, because if you can make a ridiculous amount of money, you can probably lose a ridiculous amount of money too. So it's inappropriate for the portfolio. We don't want to, we were willing to take the risk because it was Apple and because we thought it was that the positioning last month was silly, so we made an adjustment. But this month, now that the adjustment has already paid off for us, we got more bullish, and it already paid off for us and swung the portfolio 27,000 in our favor, which is obviously what's going to happen when you have one trade that can make 200,000 bucks and it goes your way. Our reaction, though, is to now say, well, great, that's all we ever wanted to do. We made the $27,000. We're very happy. Last month we were not happy. Now we're happy. Let's stay happy and cut the position down to something realistic. That's the best way to manage your portfolios. Make sure that you are able to make the adjustments down the road. I'd rather have this position make half as much money, but be able to adjust it, than to be in a gigantic position that can make twice as much money, but God forbid something does go wrong, we don't have the flexibility anymore to adjust it because it's so large. That's the problem. Because this position got so large, we don't have the ability to even put the cash into it to adjust it. So we cut this down tremendously, and we cut this in half, we cut these down, we cut this down, it's all cut down. Otherwise, everything's great in this portfolio. Everything's hunky-dory. Disney, we got more aggressive, and I think that's the only other adjustment we made this month. Isn't that great? You have a portfolio that makes $27,000 in a month, and you only have 2 adjustments. I love that. I think that's a really great way to run a portfolio. I love the butterfly portfolio. It's definitely my favorite. Dividend portfolio, that's actually down 5,500 bucks, 5,600 bucks. But we shut this portfolio. We filled it up. It's got enough. It's got all the positions we wanted because we went on a frenzy buying. There were too many good things to buy in the dividend portfolio that we just kept buying things, and then we filled it up. There's only $100,000 portfolio, and now we have maybe 10 positions. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Very good. We have 10 positions, or 11. Sorry, there's another one. We have 11 positions. They're all defined. They should make $60,000 by January 2022. And I think they're all, not that one. The TD puts the shorter term. Everybody else is China Telecom only goes to June. So a couple of these are going to close down. But where is China Telecom? It's at $43, and we sold the 37.50 call. So we're almost certainly going to get called away. That'll be gone. The short puts will be gone if they finish in the money. And other than that, these are just going to sit here and collect dividends and move forward. But this portfolio is done. Because we decided it's going to make $60,000. That's our plan. And let's see if we don't touch it again for 2 years, how closely is it going to come to our plan? So we're going to watch it, and we're going to see, and that's going to be the setup. I think we'll probably set up another dividend portfolio and do it again. So what happened is, as it goes with every portfolio, the bullish ones anyway, with the bullish portfolios, what you do is we set up a few positions. If they go well, like Money Talk, like our first 3 positions went well, so now we added 2 more. And next quarter, because we can't touch it when we're not on the show, so next quarter in April when I'm on the show again, if these 5 positions are still on track, and we should be up at least 15-16% by then. So if we're up 15 or 16% by next quarter in April, then we're going to be confident to add 2 more positions. If we're not up 15 or 16%, we're probably going to make an adjustment to the existing positions rather than add new positions. That's how we build all our portfolios. We either adjust or we add. If everything's going very well, then we add. If things have issues, we will just basically make a few adjustments, like these 2 adjustments to Apple and Disney. We're not adding, we're just adjusting for now. So that's the dividend portfolio. Do we ever get to any others? Nope, and now you're all up to date. So that's where we are. All right, so we're going to finish our portfolio reviews in member chat. Probably not this right now, but by tomorrow we'll get them all done, I think. And let's see if anybody has any questions. Nobody has any questions. Fantastic. Then I'm going to end this because it is on schedule. So thanks everybody for coming. I appreciate it. And oh, hey, somebody wrote Iridium selling. Oh, I didn't see that, Corey. Thanks. That's helpful. Iridium is selling information to air traffic. I'm sorry, I saw the price, but I didn't read the rest. Iridium sells information to air traffic systems around the world. That's how they make their money. You know what? That's a little precarious though, because it seems like anybody could do that, right? With the satellites. Now that everybody's got satellites, I think I'd be worried about them going forward, because somebody may realize that they could tap into that market and make some cash. Anyway, like I was saying, thanks everybody for coming. I really appreciate that, and we will do it again next week. All right, thanks, folks.